In this example, we are looking at the recording of cash dividends and the calculation of cash dividends into a T account. We have Avalon Corporation, who has 250,000 authorized shares of $1 par value common stock, of which 100,000 are already issued, including 10,000 shares of treasury stock. On October 15th, the corporation's board of directors declared a cash dividend of 50 cents per share payable on November 15th to stockholders of record on November 1st. So we need to take all that information and record it into the T accounts. So the first thing I want to point out are our three important dates. We have our declaration date. On the declaration date, that's the day that the board of directors said, hey, we're going to pay cash dividends, okay? And that was on the 15th. Then you have your date of record. The date of record is November 1st in this example, and that's the day that if you can imagine them saying, okay, here we're going to pull a list, here are all of the people who own stock on November 1st. Those are the individuals who are going to receive stocks. But there are no transactions on November 1st. That's just the cutoff day to decide who gets paid stock dividends and who doesn't. Then you have your payment date, which is the day that the stock will actually be paid, or the cash dividends, will actually be paid. And in this situation, it's November 15th. So the other thing we want to keep in mind is that we only pay dividends on outstanding shares. So authorized shares are the total number of shares that the company can sell or issue. And in this example, it says we had 100,000 that were issued, but then we also had 10,000 shares of treasury stock. So even though we originally issued 100,000, the company went back and bought 10,000 of its own shares, and they now become treasury. So the difference of issued shares minus treasury shares is the number of our outstanding shares. So we're only going to be paying dividends on 90,000 shares. So you can see here that we take our 90,000 shares times our 50 cents per share gives us cash dividends of 45,000 that will be paid out. So our first transaction is our declaration date on October 15th. So on the 15th, we will go ahead and debit our dividends account for the $45,000, but we're going to put it into our dividends payable account. At this point, we have created a liability. We've said we will pay them, so we're putting it into our liability account. However, they're not being paid yet. Then again, on the date of record, November 1st, we don't record anything, and then on the payment date, November 15th, we will record the transaction to actually pay out our dividends. So it no longer is a liability, so we take the $45,000 out of dividends payable, and then we credit cash and send the money to the shareholders of record.